The housing market just flashed one of the biggest warning signs in years. Right now, the U.S. housing market sellers are starting to outnumber buyers by a massive margin. Home sales are still at a very stagnant, recession-style levels, and the mortgage delinquencies are quietly on the rise. The question's no longer whether the market is under stress. The question is this: are we headed for a normal correction, or are we headed for a crash like 2008 crash that we all remember? In this video, I'm going to tell you exactly what you need to look out for to see if we're going to be dealing with a crash or just a nice normal correction. So if you're wondering whether the U.S. market in housing is going to crash, you're not alone and you're not crazy. There's a lot of signs out there. There's no inventory. Prices are nearly the fall near. Prices never really fall nationally. The market is sending some really mixed signals, and we're all wondering what is going to happen next. So, like I said, are we definitely headed to that 2008 style collapse, or are we just going to meander through the next few years? So let's talk about the indicators and what we're looking at. So number one is buyers are pulling back hard. This is related to a bunch of different things, but they are seeing some of the signs in the number of days on the market for prices. Homes that are priced not correctly are taking longer and longer. So the buyers are just not being as aggressive as they used to be. And Freddie Mac says the 30-year fixed mortgage is under 6% as of March 5th, right, of 2026. And that's lower than it has been for a couple of years, since 2022, but that's still not low enough to get buyers out in droves. And that's one of the things that's really crazy is we've seen big shifts in the interest rates, but we haven't seen that same interest level boost as we were going along. And buyers still not rushing back. So a little bit stagnant, even though interest rates are a little bit more affordable. All right, sellers are now overwhelming buyers. So what does that mean? Well, Redfin reported in January of this year that 44% more sellers than buyers out there on the market. And that is 600,000 more sellers than there are on the buyers out there in the market. That is a huge gap. It's setting records, and it's just not giving sellers that leverage that they need to make sure that they're maintaining those prices. So what does that do? That means that if you're a seller, you need to price right. If you get too aggressive with your price, it means you're not going to get that number that you're looking for because buyers just have way too many options. Indicator number 3 is sales volume looks recessionary. What does that mean? Well, that means that year over year that we're really just kind of looking at the same number of sales. In fact, in our local area here in the Conejo Valley in Moore Park and Simi, we've actually seen some pullback on the number of sales, and that is not a good indicator. That's one of those ones that's kind of it's not really a sign of collapse, but it's a sign that things are a little bit nervous. Everybody is just a little bit on the nervous side. Number 4, mortgage distress. Now, this one is where the big one that we had back in 2008, that was basically around all kinds of mortgage-backed securities and all that stuff that just collapsed because nobody was paying their mortgages. Well, those numbers, in fact, if you look at the numbers, we have more B paper to call it out there right now in volume wise than we did in 2008. It's not structured the same way, but that same B paper that's out there it's at a higher volume, like trillions of dollars. And so what does that mean? If it starts to have a little hiccup, it's going to have a ripple effect through the market, and you'll see a big collapse on a lot of prices. So let's talk about a little bit of numbers. As far as that's concerned, the overall mortgage delinquency rate in the fourth quarter of last year was up 4.26% year over year from 2024. But the FHA numbers are even worse. So people who have FHA loans, a whopping 11.5% are starting to have mortgage inability to pay their mortgage. And that is a huge number. Now, in that segment, typically that is not the segment that we're dealing with here in the Conejo Valley and like Moore Park, Simi, all that stuff as much, but that is going to affect a lot of areas, and that kind of, as all tides go, like it's going to affect us in some way. So it is an indicator that we could really start to see a crash. Those are the numbers that really scare me more than anything else. And since we're talking about kind of being delinquent, why are we delinquent? Well, mortgage rates, if you had a mortgage that you started maybe in 2002 or 2003 or 2004, your interest rate is way higher than it's supposed to be. And so right now, mortgage rates are down, but nobody out there is rushing to go buy. I feel there's some indicators that they're trying to hold off maybe for a little bit lower rate. And let's be honest, there just is mainly not a lot of cash on hand to be able to do those 20% conventional mortgages. And so even though the mortgage rate itself is better, it's still nothing what we saw 10 years ago. And secondarily, people are not having as much cash on hand to be able to make that happen. FHA is something that you could do that with because you're really only required to put down about 3%. But in our area, you're going to put down 3% just to get in the deal that gets a seller's attention. So it's not in our area a big problem where that's concerned. And what does that mean? That means there are less buyers, right? And that's what we need. If you're a seller, you need more buyers, right? Number 6 is this is becoming a buyer's market, speaking of, but only for people who can actually afford. That means that these are people who have had a little bit of extra discipline or have windfall and have some cash on hand to be able to get into the market and make those things happen. It's not about interest rates all the time. So, you're my new puppy. Anyway. And indicator number 7 is labor. Now, the unemployment rates it's a little bit regional, but unemployment rates have creeped up slightly. And if that breaks, so will the market. That means that a lot of people are not being able to buy. And along those lines, it's one of those things that in our area, there's huge drop-offs on entertainment production in LA and Ventura counties, and that upwards of 40%. And that's a lot of people who just are not able to move and move up in their house. That does mean that sometimes you're going to have those people who really kind of need to move down. And that's a double-edged sword in so much as that the house that's on the market, but that means that there's another one that's a little bit smaller that might get sucked up. That is why prices tend to be a little bit more steady, but it is a bad indicator as far as longevity for the market. It's one of those things that can be kind of that needle in a haystack that you find that and all of a sudden, boom. Now, speaking of hay, there is one little one, and it is a weird one. We have seen for the first time in a long time, the drop off in rental rates. It's only 1 or 2%. A lot of that may be because of huge numbers of self-deportation. But what that does is there's a whole bunch of in the investor market. If you have investors who are really working the margins, they are going to start to drop off as well. So that's going to be a whole nother segment of the market that really is sneaky, and it could be that straw that breaks the camel's back in this year. And for instance, California itself is 28% foreign born. And so if you have people who are just sick and tired of the current politics in the United States or self-deports or otherwise, that can be a huge portion of the market. That is nearly 10 million people in California alone that if they're really just unhappy with how the United States is going, they have options to move out of the United States. What does that do? That is going to really soften the market. That means that there's going to be even more properties on the market, or rents are going to come down even a little bit harder, which on one side makes it a little bit more affordable, but on the other side, it really softens things up for sellers. So, like I said, we're not necessarily looking at a crash, but I do think there are some signs that we really need to be watchful for this coming 6, 8 months to see if we're really going to be having some market issues and, trouble overall nationwide. Our area in the, Los Angeles, Conejo Valley area is a little bit insulated from a lot of these things, but it still can happen and it will have effect. So number one, the biggest one that I see, if those mortgage delinquencies go through the roof, like if you see another 5-10% higher than they currently are, remember it was 4.6 overall, then, or you're going to see people who are delinquent on their mortgages and they're forced to sell. So then we're going to see a huge influx of available properties on the market without that commensurate number of buyers that are coming in and sucking that up. And number two that I think is the biggest indicator is whether higher unemployment rates start to show in the housing data. We have seen a little bit higher unemployment rates. Now let's keep an eye on that, because that has a huge effect on the housing market and can be one of those things that can just flip a switch overnight. If you were in 2008, I literally remember it was March. I closed on a house in March, and it was like the next June, I think, that all of a sudden they're like, oh my God, the whole market has crashed. And then number three is seller inventory versus buyer demand. And I kind of alluded to this a little bit, but if there's way too much seller inventory, that is one of those things that it just is going to collapse the market, because but it takes a while for buyers to come out of the woodwork when those mortgage rates come down. We recently had an opportunity for the mortgage rates to come down, and that did not happen. It's up to the Fed on where those fall out. I do think we're still going to end up seeing at least 2 quarter-point drops this year, but that is pure speculation on my part. So anyway, if you're looking for more information on real estate, you need some more tips and tricks, or you just want to find out where things are at, feel free to reach out, subscribe to this channel, and I will talk to you soon.